Well, data out of the world's second biggest economy has been a mixed bag lately, but today's export numbers paint a pretty clear picture. May's figure coming in way below expectations with a 7.5% year-over-year contraction. That's not a good sign for global growth. Joining us now is David Mazza. He is Roundhill Investments Chief Strategy Officer. And Dave, we've really been seeing this sort of China ripple effect sort of day by day as we see different parts of different data points, right? Today, I think luxury companies in Europe, for example, are taking a hit, but we have seen it spread to the U.S. as well. So when you're thinking about strategy, how are you sort of incorporating the China narrative, not just what it's going to mean for China, but what it's going to mean also around the globe?
Yeah, and I think you're hitting the nail on the head. That's actually what's most important when looking at particularly China exports data. And there's no other way to read it. To your point, it's no longer a mixed bag. This was weak numbers. And in particular, the data actually would have been even weaker if it wasn't for their exports to Russia. And we all know what that's about. If you actually read through, exports to the U.S. were down around 18%, over 25% down to the EU. And that is everything really significant because now we're seeing perhaps an area that we thought was going to carry us forward and be particularly coming out of COVID. They were later to do so than other areas around the globe that's now stumbling. And I think the bigger picture, particularly when we have all of these headwinds out there economically, it does begin to make a lot less sense of how the equity market can continue to power through. And right now, futures look like they're about to be positive again.
Their own government has a GDP growth target, I believe, about 5% this year. So what does this mean in terms of tracking towards that, as some would say, conservative target? Yeah, no, that's certainly a lot different than the double-digit growth that I think many became accustomed to. What's interesting, though, today is that we are hearing reports of state-owned banks beginning to cut rates to try to stimulate the economy. And I think this is the same as we've seen other economies. The Chinese government is seemingly a bit between kind of the rock and a hard place here, is that you don't want to overstimulate, but at this point, it seems like they're going to need to go down that direction, particularly if Europe and U.S. are slowing down.
Well, we've talked to a lot of investors who are looking outside of the U.S. for investment ideas. And I think you more concentrate on the U.S., if I'm not mistaken. But, you know, how are you thinking about that sort of global allocation and how it relates to how much people are going to be investing in the U.S.?
Well, you're absolutely right. So there's really, I think, a few points here. One is heading into the year, it did seem like Europe and non-U.S. actually exposures were significantly more attractive than they had been in years. We know, particularly Europe, and to some extent the emerging markets have been unbelievably attractive from a valuation standpoint. But as we know, markets can be cheap for a long time. You recently were talking about Japan, which was a market that for many, many years, the cheapest on price to book, price to earnings, anything, but there was no catalyst. They have a bit of a catalyst now with some corporate reforms, but other markets, it's getting a bit more challenging. So the earnings growth was there, particularly in Europe. On the luxury side, those companies were some of the leaders there. Just like it's been tech leading in the U.S., it's been luxury leading in Europe. So investors began to flock there. I still think there's a big structural underweight to non-U.S. stocks. We have led for so long. The idea of diversification gets harder and harder, right? If you're continuing to rebalance into an area that underperforms, that gets tricky to do. With that being said, I think it is important, of course, over the long term to have broad-based global exposure. It's not just about the U.S. But yeah, I think if you're not having China kind of power forward that part of the portfolio, which it had been really for many years, it does get difficult to continue to make those decisions.
And we had already seen the IMF kind of put forward their targets for global growth for this year, with China and India really powering much of that. If we did continue to see weakness in some of the data coming out of China, how should investors be repositioning? Is there a trade that they should kind of be keeping in the back of their heads as they think about some of the weaker data that's come out of China recently?
Well, yes, it's to me, it's interesting because all roads then lead back to the U.S., right? So it used to be an environment of TINA, meaning there is no alternative to stocks. Yeah. Now within equities, there becomes almost no alternative to the U.S. And if we look at where valuations are, particularly of some of the tech names, it gets hard. You have to kind of hold your nose and say, I'm buying a stock that trades at this much, not even price to earnings, price to revenue of 30 times or 20 times, what have you. They're not necessarily inexpensive, but where's the earnings growth coming from? it does certainly continually seem to be the US. So even though, again, things were lining up to be a bit better, if this economic data and weakness continues out of China, the interconnectedness, of course, with economies like Germany and France in Europe, it gets a bit more murky of exactly how you would think about where your allocations should be. So I am not necessarily thinking that the opportunity in China is actually going to get much greater until we start to see some more clarity on data like the exports growth.
Sounds good. Well, I mean, of course, a lot to continue to track going forward here.